Hello and welcome to Behind the Markets. I'm your host Munyumbu Mutwale. On your Friday edition, welcome to Futuristic Friday. We've got a lot for you this morning. We've got a bond auction that has just closed down and is finally getting ready to get some numbers in. We have a little bit of data coming in for the end of the week in terms of the currencies, and we'll be talking about two things. One I call a futuristic trend, and another I call today's futuristic thoughts. But before we get started, I'd like to congratulate everybody who's managed to get into this week's bond auction. I've always encouraged everybody to say, if you can get the first three of the year, you can do very well throughout the year. So let's get started. Now, looking at data this week, we have seen that the FX market has continued down its negative spin. And I think one of the biggest pieces of data that we got during the week was to see that this is not even the Bank of Zambia taking a lackluster approach. They're dumping record levels of FX into the market, and it's still not doing anything. Today, we saw the Kwacha go down by another 0.29%, closing the week 0.65% weaker, and the year 7.38%, making this one of the strongest assets, the US dollar, during the year. We're on a 94-day losing streak at a 52-week high, and all signals are still saying bye-bye for the dollar. But for the first time, in terms of the trends, we're actually seeing the MACD, which is the directional index, showing that we might start seeing a few cracks in the dollar. But this could be whether it's the exchange, whether it's the interest rate, or whether it's also got to do with, in part, the reserve ratio that might start playing a role. So we'll start to see in these 3 months what we're going to start seeing from the market itself. But altogether, we are seeing that the FX market is doing relatively strong. On the other side of the equation, we're seeing that the US, that the GRZ bond index is still moving 0.6% up and is up 4.03% year to date, especially on the secondary market. And we're also seeing that in US dollars year to date, 2.91%. The US dollar version of the bond index is down, and interest rates are still sliding slightly downwards, 0.08% down year to date. And we're on a 36-day moving streak upwards when it comes to the bond index, when it comes to the Kwacha value of the bond index. So bonds are still the defensive asset, but we are seeing that it is in the commodity space where we'll probably see a lot more of the better markets to see. Now, we're seeing copper bouncing back up above 9,000, up 2.07% from this year and 7.98% year to date. Still signs that China is starting to recover. Data has actually even started to show that Chinese tourism, which helps a lot of smaller economies and a lot of smaller countries, has actually started to return to the market. So we actually seen a few countries who benefit from Chinese tourists coming into their country have actually seen that doing well. Oil went down about 0.05% due to oil numbers in terms of oil barrels were actually up too much. So negative 0.05%, negative 0.5% downwards. Oil is still down year to date, 1.12%, and on the year down 10%. Right now, we are seeing that if there was a pump price adjustment to where we are right now, we'd probably find that the pump price would move up to 28.08. That is a 3.2% upwards, mainly because of FX loss. Nothing to do with the oil price. Oil is exactly what it was last month, and unfortunately, it is just our weak forex rate that's actually hurting us at the moment. Gold itself is up 0.26%. A few recession fears starting to sneak in, and only year to date, we're seeing gold up 1.31%, up 8.79% in Kwacha, mainly due to the dollar effect, and the gold itself would have actually been playing a role. So you can see that it is other instruments that will be doing well this year. So now, if you're in the crypto space, that's where we are seeing a few wins here. Bitcoin up 6.72%, and Ethereum up 5.21%. We're going to be talking about Ether a little bit later in today's show. Now, we do see that year to date, we see that Bitcoin is up 60.34%. Remember, this is a wildly volatile asset. I always advise this to be in what we call the wealth insurance component of your portfolio, where you have Bitcoin, Ethereum, gold, and dollars that never really exceed 15%. If you want to keep cattle and all sorts of things there, that's what you want to try and do. So that is what we call the wealth insurance component. Ethereum up 52.74% year to date. Yes, these are wildly performing strong because the markets are still in a defensive posture. The kwacha is still doing very weak. The country is still in an uncertain position, and we are still trying to figure out where we are going as a country. So this is going to be quite a difficult period. Now, looking into data, looking into global data across global markets, we do see that from our economic calendar, yesterday we did get a few inflation reads and we did get a few business reads. Now, what we saw yesterday at the beginning was UK inflation showed signs of coming down. UK inflation down 5.8. It's down to 5.8% year on year, month on month. It's negative 0.9. So UK has actually moved into core disinflation. PPIs in the UK are down to 0.6% upwards month on month, and year on year only down to 11.1%. And also now CPI month on month in general is also in a disinflation pattern of 0.6%, negative 0.6%. And inflation has come down to 10.1. So really the UK is starting to disinflate right now. But remember, the problem with the UK is it might be one of the major economies that actually might slip into a full-scale recession. So everyone is worried about it, that it actually might start contracting this year. Now, going into also PPIs in the UK in terms of input costs, they've gone down from 16.2% to 14.1%, with a negative with disinflation PPIs in terms of input costs going into manufacturers of 0.1% versus disinflation of 1.1% previously. But the expectation was that there was supposed to be inflation this year. Now, we also did see that output costs, unfortunately, in the UK are coming up. So if you're importing things from the UK, you are expecting that inflation did go up 0.5% month on month, but then year on year, it slid down to 13.5% base effects actually playing a role. Now, the other part we're seeing also is Saudi inflation came in 3.4% just as expected, while Spanish inflation has come in a bit hotter. So you are seeing that countries like Spain and Italy are still going against the trend. Now, the one that matters to us most as Zambians is South African inflation. Core inflation in South Africa stayed down at about 0.2% month on month, while year on year inflation is down to 4.9%. So those record levels of inflation have slowed down in terms of core inflation. But the main CPI read has dropped from 7.2 to 6.9 because energy and food prices are starting to slip down, while their next door neighbor, Namibia, has gone through a month-on-month inflation of 1.1%. Prices in Namibia are starting to shoot up with 7% year-on-year inflation. And also, while on the other hand, Botswana's inflation is down from 12.4 to 9.3, with disinflation of 0.6% coming into Botswana. So there's all sorts of inflation reads coming across Africa. Simultaneously, Nigeria's inflation went up to 24.3% from 23.75. This is food inflation in Nigeria. While we also took a look at South African business confidence, which is slightly starting to pick up. So that's actually quite shocking, especially given the gloom and doom nature of President Ramaphosa's speech. Now that's also important. Remember that when South Africa is producing more, we kind of get cheaper goods off the back of that. Simultaneously, we also saw industrial production in Europe down. So industrial data is weak as well, with trade balances in the UK negative. Simultaneously, also we saw CPI data generally coming out of Nigeria also higher as well. So food inflation plus general inflation still at 21.82% in Nigeria. While we're also taking a look at retail sales in the US, South Africa, which came in weaker. That's not good for us. That's not good for the growth sector of the African economy. And mortgage data in America, the mortgage rates are at 6.39%, showing a little bit of upwards pressure in the interest rates, which is not good for us. We're trying to expect offshore investors to start coming back in, but good for the local bond investor who can continue harvesting higher yields until these offshore investors become comfortable coming back into Zambia. So we are seeing a little bit of a slowdown in the housing sector in America, but we are seeing the retail sales sector in America also coming up quite strong, month on month 3%, year on year 6.8%, 6.38%. So we are seeing a bump up in US inflation, US retail sector. But the biggest thing that pushed oil prices down was a barrel increase of 16.283 million barrels of oil, and that's why you saw oil projecting a little bit weaker. That was yesterday. Now coming so that was 2 days ago. Now coming into yesterday's data, because we are reading it from Wednesday data. Now we are coming into yesterday, which was Thursday the 16th. we are seeing the trade balances in Italy were still on the negative wind. We did see that the repo rate in Rwanda had to go up. So interest rates in our neighboring countries are also having to push back up. But we also saw that core PPI in the UK, in the USA, also went up. So supply chain inflation is slowly trying to creep back in, while building permits in America are a bit down, while continuous jobless claims have also started to rise up as well. So a lot of unemployment insurance starting to get claimed in America. Housing starts also coming up. So industrially, the world is starting to wobble a bit, while inflation is starting to creep back into the supply chain. And simultaneously, we are still seeing mixed reads of growth, with interest rates starting to pick up again. So there are threats coming around us regionally and starting to circle around us as a country. And some of the latest news that we are seeing is still the same thing: dollar getting stronger, and a lot of the markets are starting to shiver a little bit based on all of this. So that's main data. Some more news that actually kicked into the market also today was that the World Bank chief, David Malpass, says he is actually going to resign by the end of June. It's a surprise move now, and they're actually now starting to plot as to which direction to try and go and who to actually pick as his replacement. So that's actually, and this is in the middle of Zambia's debt negotiation. Remember, he's one of the voices that's actually lent to us in terms of our debt negotiation. Malpass was a Trump nominee for the World Bank position. So that's actually some of the news and will affect us as a country, and it was something that we should actually start watching out for. Now, in the other pieces of news, we did see the stock market go up about 0.27%, up 0.32% on the week. 1.32% on the week and 0.39%, reversing some of the losses on the month. So momentum is starting to pick back up. Biggest stocks that performed this week: Standard Chartered up 8%, British American Tobacco up 0.5%. Worst performance of the week, Zanaco 5.72% down, with CEC down 0.5%. Interesting news that captured CEC this week has to do with the fact that CEC added 34 megawatts of electricity, but solar electricity. So it's one of the few. Now that's increasing our solar capacity, our installed capacity, by almost 25%. By almost 30%. Remember, we had 89 megawatts of solar capacity. Now we're sitting on about 123 megawatts of solar capacity. That's the same size as the Teji power station. So it means that our solar is now a little bit significant, and it actually adds a little bit to our grid. But remember, we still have Masdar and Zesco, who are going to be working together to try and see if they can put 2 gigawatts of power in terms of solar installation. That's going to make Zambia one of the greenest nations in terms of electricity, if we are not already. In terms of our hydro dependence, we are now starting to put quite a bit of solar into our system. So that's a big sale coming. That's a big step coming out of the stock market. Now, what that'll do for CEC, I think it's just going to be a signal as to what we're going to be doing, what to expect in terms of the green energy revolution. And that's about quite a bit in terms of the market recap. Now, for today's conversation, I want to give you two things. I want to give you my future thought, but one of the things I wanted to share actually came from the central bank conversation. It's one of the things we kept out yesterday. So here's a video clip that I want to share of one of the questions that was asked to do with change inside the sector. So here we go.
Of load shedding was pushed by a fast-growing domestic sector that desperately needs alternative energy, such as household solar, affordable and easily accessible finance to install such systems. What tools does the central bank have at its disposal to support lower interest green electricity loans for the domestic sector to help electricity not be a hindrance to economic growth?
We have seen the impact of climate change and environment generally in Zambia. We've already begun to see recently even things like flash floods. At what impact does that have on the community and the populace at large? So what the bank has been doing, firstly, we've been building capacity to see how can the bank contribute towards enabling financial institutions to give appropriate credit, especially to promote the green finance agenda. So we're actually working on green finance loan guidelines. We've had a lot of engagements with other institutions such as the Alliance of Financial Inclusion, including with other bilateral, multilateral institutions such as the World Bank, Financial Sector Deepening Africa. So we're working on extensive directions to the financial institutions to see how we can promote, to enable them, provide credit which will help institutions which are going into the green sector. I think that is what I can say for now. Thank you.
So that was actually a question that was asked by our very own Cecilia. I would like to thank her again for bringing that up. And just to add a little bit of context there, we did see that load shedding, and this was a conversation we had a few Fridays ago about how we should actually be considering taking as many families off the grid. The only problem is that going off the grid is as expensive as buying a car, and a very expensive brand new car in some regards. So we're talking about 60,000 to 120,000, even as high as 150,000 if you include installation costs. Now, this is quite serious for the average household in Zambia, and especially given that green energy supplies can actually are becoming a little bit more expensive because of the raw materials that need to go into them, whether it's rising copper prices or rising commodity prices that are included in their production. So you want to try and make sure that the prices of these things are, one, affordable, and two, the financing for it is affordable. Now, right now, we're sitting at interest rates that are way over the 20%, which are way out of most people's reach. So you want to try and bring interest rates down to 10, 15% to incentivize as many of the biggest households in this country. We're talking about households that use about 800 kilowatts a month of electricity, to try and get them to get off the grid with the hopes of taking off as much power out of the grid as possible. So if you can try and get those 800 to 2,000 kilowatt consumption houses off the grid, that's the same as building a power station, but more scalable, easy to use, and faster to implement. So now the key to all of this is quick financing. If you can make it cheap and affordable for as many people. So the question that was asked is, what tools does a central bank have at its disposal to try and incentivize banks to do this? Now, we're not just trying to talk about the central bank trying to deploy capital, but we did see last year that the central bank managed to whip out a 10 billion kwacha stabilization fund in order to stabilize the economy. And I wonder if questions cannot be asked if the central bank can do something similar in terms of loan creation to try and support green energy, to give some sort of stabilization fund at a much more concessionary cost. Or could there be some sort of government guarantee? We have Zambia Guarantee Scheme, which could be able to step in and guarantee some of these loans as an insurance package to lower the prices. Or what we also could be doing is giving banks tax incentives. I personally think that we shot the pooch a little bit by giving banks tax incentives for nothing. I think the tax incentives that some of these companies, especially even banks, should be conditional. We have banks who are making record profits, lending to government as opposed to lending to the economy. And we saw Deputy Governor Chipimo actually point out that this is a risk, but it's not also good for the country, for banks to be making half their profits by just lending to the government as opposed to lending to the rest of the economy and growing their bond portfolio instead of growing their loan portfolio even faster, trying to get things to small business. So here's my recommendation of what we should be thinking about whenever we're taxing banks. What we should tell banks is, what percentage of your portfolio do you lend out to small and youth and women-owned small businesses? Or what percentage of your portfolio is sitting in the hands of small businesses, your loan portfolio, including government? Okay, if we actually look at all of that and say what percent of your portfolio is sitting with these, then that percentage, then based on that percentage or a target percentage, do we then issue you out a 5% tax? Then also, what percent have you issued out for loans for solar? And then you can also get a tax cut based on that. And effectively, what we should be talking about is banks that loan in large quantums to small businesses and household for solar, or at least for green energy or alternative energy transition. Banks that do that should be paying taxes as low as 25% as opposed to the 35%. And I think it's 30% right now. And I think banks should be paying 35% if they do not adhere to that. That should make the banks get an incentive. Now, let me put this in a mindset for you. If the difference between doing that was a 10% of your taxes, think about a bank like Zanaco or a bank like ABSA, who now has to go out there, look out how to finance green energy, and they made 1.9 billion kwacha worth of profit last year. Now that's a difference of about 190 million to almost 200 million kwacha of new profits that can actually be sitting in the bank if they just adhere to trying to take a little bit more risk. It's a compensation for more risk. Now they're talking about green loan frameworks, which is good. How do you get banks to do that? I think we should be giving them tax incentives and whatever other systems and tools that we can try to use, and whatever other partnerships. Should we have guarantee funds? Should we have tax incentives? If we're going to get our banks to start issuing out capital, let's make sure that it's targeted in the right places to try and make sure we stimulate growth, as opposed to just doling out cash to the government or doling out cash to a few select small businesses that doesn't do too well for the economy or doesn't make the change that we're trying to see it make. And remember that green energy could also be the frontier where we actually get a bit more change in society. So this is a trend that we're trying to see, the green financing agenda, how to get green loans moving. And that's something that we just like to post and share for everyone to see. So check it out. Give us your thoughts on it to see what should the central bank and what should they be doing? What should central banks, our government should be doing? Do you agree that banks who loan green and loan small should then be entitled to better tax regimes than banks who do not, so that we can actually put a positive behavior incentive towards our banking sector? That's just something I wanted to put out there. However, this actually segues into a second conversation, which we should be talking about in Zambia, and that's got to do with the growth horizon. And this is my Friday trend, my futuristic Friday trend, which I'd like to share with people. Now, one of the biggest concerns I've had with this country is the battle between growth and inclusivity. That's always the big issue with Zambia. And it's captioned in something I call professionalism versus populism. And as a country, what always ends up happening is that we hand over the country to professionals who then grow the economy very well. They build structures and salaries go up, but unfortunately, it excludes large swaths of the economy. All the loans go to the top 1%, 2%, 3% of people, and the inequality widens and you get disdain. So you get this broad economy, this big economy that moves, but there's a huge swath of it that's left out of the growth, and only a few people start to experience the growth. And you actually start to see the poorer parts of the economy get weaker and weaker. And we saw this under the Mwanawasa regime, where we saw the top part of the economy do extremely well. Their incomes grew drastically, but unfortunately, the bottom part of the economy actually even got more poor. And that's what led to the rise of the PF and the populist regime, and that pushed for the rise of populism. So what you don't want to do is have that divergence inside your society that ends up bringing more problems, that ends up bringing more economic problems. So what we want to try and take a look at is, I want to start by sharing what I see as the missed growth trajectory. So what we did was we gathered some data on Zambia over the last decade, and how has Zambia grown in comparison to its neighbors and some of its peers. So we gathered some of the peers of Zambia, and here's the data that we've picked up. And if you can see that correctly, you're able to see that you're able to see Zambia here is the final one at the back here. So this is 2016 to 2012 versus 2011 to 2016 to 2021 versus, and the blue lines are 2011 to 2021. Now, this is percentage economic growth. So in other words, how much has the GDP changed over this period? Now, let me just open it up. You can see that number one, obviously, here is Malawi. Malawi has grown 132% just over the last 5 years. It was going through a decline at the beginning and then picked up towards the end and had one of a major record rally. Malawi is up 57% in terms of economic growth. Democratic Republic of Congo is up 49%, our next door neighbor. Another one of our next door neighbors is up 49.1% over the last 5 years and up 114% over the last 10 years. Now, I want you to just quickly keep your eye on that data, because I'm going to show you Democratic Republic of Congo and Zambia. Kenya is up 47% in the last 5 years, up 135% in the last 10 years. And you can see Uganda basically was down a downward spiral, but then picked up. Uganda's up 38% in the last 5 years. You can see Zimbabwe even is up 38%. This is your GDP in dollars. Zimbabwe is up 38.1% and up 101% over the last 10 years. Tanzania is up 36% and up 95.6% 28.7% over the last 10 years. South Africa is up 29.5%, but shrunk over the last 10 years because they went through a horrible 2010 to 2015 period. Rwanda is up 27.4% and up 60.9% in terms of the size of their GDP. Botswana is up 16.8% the first 5 years it was with South Africa, no movement. And Zambia, there we go, only up 5.7% over the last 10 years and down actually over the last. We have lost growth. So if you take a look at where we were supposed to be, we are supposed to be friends with DRC in terms of what we're supposed to be, where we're supposed to be economically. So this data shows you that Zambia has unfortunately lost its growth swing. And this is a chart I shared on my this is a chart I shared recently for everyone to consume. And you can see that unfortunately it has been a tough swing for Zambia. But I want to show you just another path. Where did we miss out on growth? And where you want to see how badly we've missed out on growth, take a look at our chart versus the DRC. And that's where you start to see how bad this gets. In 2001, you can see that Zambia and DRC, by the way, has got a population currently of 95 million people. So DRC is basically 20 times, sorry, not 20 times, it's 4 times our population, not 5 times our population. And we have an economy that's only half theirs. So you could see that for the first part of the 2000 to 20, all the way up to 2013, but just really up to about 2011, Zambia and DRC's economies were actually moving closely together. And in fact, from 2006, when we managed to do our structural reform and grow our economy, Zambia was actually catching up to the DRC. Take a look at 2010. 2010 data here you can see, and I'm just zoomed in here for everyone to be able to see it. 2010, you can actually see here, DRC, Zambia were just $1.3 billion kwacha away. I mean, $1.3 billion away in terms of their GDP. By the way, this is Zambia versus DRC GDP in dollars from 2001 to 2021, World Bank data. Now you can see that a slow divergence started to pick up after the change with which we moved to populism. And Zambia, which is the green line, starts to go flat, while the DRC, which is the blue line, continues its steep rise. It had a few flat years from 2014 to 2016, but then continued back upwards, dipped a bit during the pandemic, and is up. The DRC economy is now $55 billion, while Zambia's economy is stuck at $22 billion. We are actually less than we were in 2013, while DRC has almost doubled what it was in 2013. So what we have is we've lost a whole decade of economic growth due to populism. So professionalism drove us to that point where we got to a $28 billion economy, and we should have been there next to DRC, somewhere around a $50 billion economy. But here we are at a $22 billion economy. And these are two painful stories that we have to start to look at as a country, is how did we lose so much growth? And this is the conversation about professionalism versus populism. And the reality of a country like ours is that we keep on dabbling in populism because professionalism fails to address inclusive economic growth. So it does well to allow the top parts of the economy to grow very well. That's the Bonawasa regime. So they cut budgets. They make sure that the loans industry does very well. But what unintentionally happens is the people who grow exclude people. They start to do business abroad. They start to bring in external contractors. And I think that's been the push about making sure that we have broad-based inclusive economic growth. If we're going to grow mining, we need to grow artisanal mining. If we're going to grow banking, we need to make village banks are doing well. We should be talking about things like the Deposit Insurance Act so that we can try and help stabilize and actually regularize and formalize things like our village banks and our informal financial systems, to be able to bring them to the fold and actually include as many people, not just in transacting money, but enable in the ability to invest money and to do more with money, and including building wealth with money. So this is some of the things that we have to work on. But there's something from the central bank speech, the central bank conversation, which did irk me just a little bit. And it's this data here. I breezed through it yesterday when I went through central bank data, but here's it is more importantly. This is mining data, mining tax data. And I want to just settle on this. We gave mines tax breaks, especially in last year's budget, going into this year. Mines are now dealing with a more friendly tax regime. We've also given mines a tax break on importing machinery. We've also given them the ability to claim back their VAT. So there should be a lot of money sitting in the tax system here. We should be getting mines that are producing more, but we're not. We've got mines that are producing less. And this has been happening throughout last year. Not sure, maybe the conversation is that maybe they're deep in exploration and things are changing a bit. And there are stories that we should start seeing a recovery. But we saw a lot of loans going into the mining sector. If you took a look at banking data, we saw a lot of loans going into mining sector. So take a look at what this data shows. This is mining taxes this is mining payments directly paid in US dollar millions to the central bank. So take a look at mineral royalties. $106 million worth of mineral royalties, 35% less than the previous quarter, 42% less than the same quarter in the previous year. If you're talking about quarter four, other taxes such as company taxes and anything got 78.4%, 37% below, and 50% below what it was in the previous year, and 37.38% below what it was in the last quarter. $185 million worth of total taxes collected from mines, and that is 36.19% lower than the last quarter and 45.97% lower than the same quarter last year. We really had a poor year, and this is what's ripping our currency a new one. Mines are supposed to be our biggest source of inflow. The two biggest sources of forex are supposed to be mines bringing in dollars through the tax system and offshore investors coming in to buy government bonds. We are getting neither, and our currency is getting the shellacking of the century, and the bottom part of the economy is handling that the worst. And you can see even on the year end, yes, we have had a 0.5% increase, but this is after giving quite a bit of stimulus to the mining sector. And then 587,000, you can see 587 million, which is 9% below. So we've seen 4% less money coming in from the mining sector. So what is the benefit? Are they creating jobs? Are they creating business opportunities? What is the benefit that we are doing in order to give these companies such breaks? And are we going to see this turn around? Because if we do start to see our mining sector turn around and we see a lot more profit in it, that's a different story. But this year, it's not just been that we've seen lower copper prices. It's a mix that we've also seen poorer output. And we're not getting much output in terms of that. We're also not getting much export. So we've really had bad export, lower numbers than the year before in terms of the export output. And at the same time, we've got lower prices to contend with. Now, the lower prices will actually at least reverse in the interim. We should actually get a bit more investment. So what should happen to improve this situation? Not where we give huge breaks to mines, but we actually allow our economy, our total economy, to benefit. Now, we've tried the situation of increasing taxes on mines. It wasn't too successful, people. Unfortunately, it led to a lot of shutdowns, care and maintenance, battles, issues, and then we ended up with a lot more people being jobless and towns being mothballed. So we have to be very careful about thinking tax is the method with which we can get these mines. Should we be structuring the tax incentives, like I talked about for banks, also for mines, to start talking about things such as SME, youth-owned business, contracts? Should we be getting women and youth business contracts to mines and tell them, look, if X% of all your supplier costs are actually now paid to, if X% of all your supplier costs are actually paid out to small youth or women-owned businesses, then you can actually get some access to some tax relief. Are you giving out scholarships? What are you doing in the society and in the community? So taxes should be structured in a way that there should be some sort of behavioral requirement rather than just given to the mining sector. I think this is where the problem comes that I have. I have no problem with cutting taxes for certain institutions. I have a problem with just giving them tax cuts without them earning it in some way. Let these people earn tax cuts. That's what I mean. Let them earn, give them a path to say, you can pay X lower taxes, or you can claim this on your taxes if we see this from you. I think this should be the change that we should start seeing in the way that we approach our big businesses, our banks, and our mines, to start saying, if you want to touch a lower tax regime, you are going to have to give the economy much more inclusivity of the smaller businesses, women-owned businesses. We're going to have to see green business, like also in terms of your ways of doing business. We're going to have to see these things. And then after that,
once we've weighed you up, then we can actually offer you a much better tax regime than to just say we're just cutting taxes for you willy-nilly, and therefore you can get it as quickly as you want. These are the problems that cause inequality, because if you don't give them conditions by which they should obtain those tax relief, they will just abuse them most of the time, and they'll say, "No, it's all good and well. This is the reason it didn't go to well. That's the reason it didn't go to well." They end up just abusing these things. Now, I know that I've also been supportive of things like the ZCCM deal, and I still am. I think that's a very good deal because that puts a lot more cash in the hands of an entity like ZCCM, who we have a lot more control over as a country. So those are some of the things that we can try to do: get more cash into the hands of ZCCM, who can try and do a bit more exploration and get a bit more power into the mining sector, and therefore we can have a bit more control over the exploration itself. We should also try and see if we can get as many better partnerships. Now, I saw the mines minister going into the Indaba, and he issued a statement, and he said, "Do not be fooled. We need FDI. We need investors. Don't let anyone fool you. It's just about negotiation." So here's what I think, unfortunately, about that statement. Now, I'm not blind to the fact that we don't have the domestic capital to build the mining outfits the way we are, or even to take over. One, I think that we need to make sure that we develop mining skills. That's one thing we've always overlooked. Because we don't have the capital, we always just disqualify our ability to build systems and skills, though the mines are pretty much run by local people. The Minister of Trade and Commerce was a former operator of the mines himself, of a mine himself. That's the quality of skills we actually have in this economy. So I don't see an issue with that. What I do see an issue with is we shouldn't be trying to rush to get investors without building leverage. I mean, this is the problem I have. If you want to deal with investors, you need to have negotiating leverage. In order to have negotiating leverage, you need to be able to do things by yourself first. This is the lesson China has learned. China built their economy before they let people in. And then when they let people in, they told them, look, our businesses are already established. So if you want a piece of them, you're going to have to pay premium price and only take a small slice of equity. In Zambia, because we're offering people virgin land and unbuilt industries, they're able to take large swaths of your activity because of that. And nobody is out there trying to develop and stimulate the skills of people so that when they go out there and negotiate with people, you're negotiating from a place of strength. Let me give you a simple example. If you start a business and that business if that business has never made a sale, when you get an investor, that investor can take 20% of your business, 30% of your business off the bang with just the first investment they can do. Okay, because it's an idea. Anybody who puts money in an idea can automatically take 20 to 30% of that business, no matter how much you've asked for them. That's how difficult selling ideas is. But a running business with cash flow, with customers, with growth, with cash sitting in the bank, with supply chains and relationships, that kind of business, buying into that becomes a little bit more difficult. You're buying into a mature business. You're buying into something that has been de-risked. So teaching Zambians to start from scratch entrepreneurship, build their entities from nothing, start in the lower areas and reinvest, give them money acumen and business acumen, developing those soft skills and that mindset and mentality actually helps improve us. So in as much as we want to revive our mining sector, we also need to make sure that we offer mining schools and classes to these people who we call Jerabos and so forth, and that we've said so much about. We need to be able to do that. We also need to be able to get people to start participating in broader parts of the economy in better ways and learning how to build businesses through, not just to make money, but to build businesses. These are two different skill sets. Making money and building a business, yes, they can intermingle at one point, but they are two different skill sets, and we need to encourage people to start utilizing them a little bit more differently. So that's what I mean when I start saying that we need to start trying to build that leverage point so that when an investor comes in, they find established businesses or at least growing businesses. And once businesses have been de-risked and entered the growth phase, capital becomes much cheaper. It gets less shares. It costs less in interest. That is how you actually get your capital costs down around the world, by de-risking your enterprises, by taking the risks yourselves as entrepreneurs. And that requires deregulation. That requires training. That requires development. That requires small sector loans going out. That requires a more liberalized lending system, not just so that big businesses can kind of dole out all the cash, but we're talking about a lower level, poor man's bank businesses, where you take in the village banking system, train it and groom it so that it operates the right way, not the way it's operating right now, where a loan from a village bank is more expensive than a bank loan. And the only advantage is that it's accessible. Where a loan from the village bank should be less, and therefore the interest and savings that the village bank members get should be a little bit higher. That should be what we're talking about, not the mess we're doing right now as an economy. So we should actually be talking about trying to get rid of these disparities in our growth. They are systems of exclusion that are actually built into our economy, which we need to address very carefully. And it's not this battle of neocolonialism and all these terms people like using. The actual issues here are that we are not engaging in enterprise in a way where we dig and build things from the dirt and rise them up, starting from desks, starting from a room. And how does somebody go from operating in a very informal fashion, training them, learning to do accounts, learning to do their books, bringing in professionals and growing that business to a point where it is fully functional? Just like some of the starlight entrepreneurs we have in this country, be it the president himself, Stephen Mikalile, these kind of people, Mr. Fumbeshi, these people who have built enterprises from scratch, grown them, hired people, expanded them, gone into multiple places. That acumen, how do we duplicate that amongst as many of the people and build a culture? Because what we're missing in this country, we can talk about capital, we can talk about cash, we can talk about costs, we can talk about all these things. But one of the things we really lack in this country is an entrepreneurial culture. And we haven't built that properly. And if we spend a bit more time working on entrepreneurial culture and financial culture, we'll actually see that a lot of the things we're fighting will become a lot easier to fight. And a lot of the inequality we're trying to deal with is often knowledge inequality and social inequality. It is not economic inequality of its own. Economic inequality is the thing that we see at the end. It's the symptom, but the real sickness is knowledge inequality and social inequality, where people don't know enough or don't know enough people to do business with. That's, I think, one of the main points I wanted to drive at in this professionalism, to actually try and put a butt in it. And I hope this is a conversation we can actually deal with. And finally, in my futuristic thought, I am looking at the economy of tomorrow. And I want to start with a quick video by a man named Dr. Jawanza Kunjufu, who's an American educator. He's a psychologist, and he studies these things about the destruction of society. He was talking about destruction of Black society. This is a talk he gave many decades ago. But think about how creepy and eerie this is to being correct.
Wife ends in a divorce in 18 months. Now, you see, it used to be if you got divorced, something was wrong with you. But when you have a stat this high, something must be going on in society. I now want to explain what that is. When America believed in agriculture, America believed in extended family. When America believed in the factory industrialism, America believed in the nuclear family. But now that America believes in the computer, now America believes in a single parent family. Make sure you see my analysis. When the economy changed, the family structure changed. There was more than love in these relationships. There was some money involved here. Our grandparents worked the fields together, had economic reason to stay together, and so they did. In a factory, man works in factory, woman takes care of children. Economic reason again to stay together. But in this new economy, where you now have women working just as much, if not more than men, you now hear women telling men, I don't need you, got my own job. Do what I want to do when I want to do it. And we are now doing it very well and by ourselves. You know the #1 song in America a couple years ago, ain't nothing going on but the rent. If you want to be with me, you got to have a J-O-B. It's all about money. All about money. When the economy changed, the family structure changed. And so now we have a lot of people making plenty of money and lonely.
And this is something that's actually happening in society. And me, who's in the finance and wealth world, one of my biggest reasons to do what I do in terms of financial advisory or business advisory or wealth in general has got to do with keeping families together and working on families, because money is at the cornerstone of most people's view of family. And this is something that's actually quite interesting that Dr. Kunjufu pointed out. He says that as the economy changes, so does the family. When we are in agriculture, we are extended family. Actually, if you look at Zambians who live in the village, that's where you get those huge extended families who live very close to each other. And it's important to have your aunties and your uncles. And that's how we have that culture in Zambia of, your father's brother is your father, or your mother's sister is your mother. You see, like your aunts and uncles are the same as your parents. Your cousins are your brothers and sisters. That mentality or that mindset comes from an agrarian society. We are shifting. Now, one of the things you have to remember statistically is that Zambia, by the year 2030, is going to become a majority urban country. We always believe in the rural farm Zambia. But what we haven't paid attention to is that Solwezi, Lusaka, and Copperbelt have grown at such rapid rates in terms of the population because of non-economic growth, population growth. But two, biggest thing is migration into those areas. Because remember, 55% of jobs are in those areas. So because of 55% of jobs being in those areas, economic activity being in those areas, MPs being in those areas, political activity, culture, entertainment, everything, it bubbles in those areas. So everyone comes to these spots. Now, what starts to happen in society is that if we don't pay close attention, and if we don't pay really close attention, we are actually creating family changes, and they are family changes that are happening. I think we've seen reports in this country that marriage rates are starting to decline. We're starting to see the percentage of people who are unmarried by adult years are actually picking up, especially between the age of 20 and 30. Those numbers are picking up. And we're not trying to say some of that is also due to the removal of child marriage. Thank goodness that has happened. But we're seeing the ages that people are actually staying unmarried are getting higher and higher and higher as a country. The other thing that we're also starting to see is that divorce rates in this country are rising. Single parent houses are starting to rise. Men who are no longer taking care of their children are starting to rise astronomically. We went from numbers as low as only 20% of children not seeing a father in the house, and we're heading to 40%. This has all happened in one generation, from the year 2000 to 2020. This has all just happened. In one single generation, we've gone from 1 in every 5 children to not seeing their father to 2 in every 5 children now not seeing their father. We're going to be over half by the next generation, and that's it. Before you blink, we're now a fatherless generation. And that stuff is actually quite shocking to society, and it's a huge change. But as the economy changes, so do these things change. You see, people in the farmlands are extended family. When factories happened under President Kaunda, when we were more of a factory community, where it was industry, it was battery building, it was all that, it was nuclear family that was really important. But in the information and technology age, where we're all earning equally, where it's very easy to earn equally, and you don't have to have someone taking care of your family back home, you can both equally work because it's more soft skills and more knowledge-based. That's a different thing now. It's no longer a tag team raising homes, it's individuals. And that also now affects people's needs. That affects people's psyche. If you want to take a look, and I'm going to get down to some of this information just now, but that affects people's mindsets. So I want to just bring you close to this as to what we mean by the gap has been closed. Most people seem to not understand, and I know because we have all the gender conversations in this country, we tend to not see the how quickly the gender pay gap in this country has actually been closed. So let me actually grab some of the data to show you. This is wage data that actually shows the general wages in this country for both men and women. These are called real wages, inflation-adjusted wages, with a base year 2010 based on labor force statistics. As you could see, back in 2012, women were earning 6.62 kwacha per hour in terms of the work, in terms of real terms, while men were earning about 8.92. But from about 2014 onwards, women have actually overtaken men in terms of per hour wages. Yes, women do work a few less hours, men work more hours, especially men who work outside a lot more, work in factories a lot more. And I know we have women who work in the markets, but they're different jobs. We're talking about construction, all sorts of things, conductors. Those are mostly men. Bus drivers, those are mostly men. Those guys work up until 22 hours. But what you notice is that the wages for men and women are actually sitting at an equal point as far as the 2020 labor force survey. In fact, women are slightly higher by about 23 ngwe. So you can actually see women are actually out earning men. And unfortunately, during this decade, as you've seen women out earning men, unfortunately, what we're also witnessing is that the divorce rates are starting to pick up as well. Now, is it caused? No, but they are moving in parallels, and you do see this happening in society. So this is what he meant when he said that women don't need men anymore because they can earn as much as men and don't depend on them for their earnings capacity. Another piece of data which we'll actually pick up on in terms of all of this is I can break this down in terms of the formal sector and the informal sector. Now, most of this equalization is actually happening in the formal sector. If you actually look at from the year 2012, the formal sector was actually where women have already been out earning men, and they're out earning men 20%. Sorry, almost 15%, not 20%, 15%. They're actually out earning men. The average woman is earning 12.05 kwacha base year 2010 in terms of per hour, while the average man is earning 10.78 kwacha base year. So yes, we can have these debates and you cannot feel funny about it, but the reality is women in Zambia earn more than men in the formal sector. These are the numbers. Fight them as much as you want. These are the numbers. Okay, and you can see the average is 11.16. So women are actually earning more in real terms versus men, and this is in the formal sector. However, when you go into the informal sector, which is a little bit more interesting, you'll actually necessarily find that it's the other way around. Men are out earning women in the informal sector. And this is where the data actually shows it here. You can see that men are actually out earning women and women are far below men. The gap narrows a little bit in 2017, but you can see the informal sector has had a collapse in real wages, and it's actually been the women. This is all data coming from the labor force statistics from 2012 all the way up to 2020. And finally, you can see that the parity, if you want to take a look at gender equity of pay in this country, you will find that it is women, it's actually in the formal sector once again where you find this gender equity. So it's actually in the formal sector where you find a lot more of the gender equity in terms of pay. And here it is. This is the women's wage versus the men's wage. You can see that as 2017, which was the highest, women were actually earning 45% more than men. In 2017, those numbers came back down, but women in the formal sector are earning about 12% more than men, while women in the informal sector are the ones who are under earning men. And you can see that's where the changes come from. But on average, the average Zambian woman out earns her man. And this is a huge change to society. And I want to show you quickly why. I know that really gone into a large stretch here, but this is my future thought, which most people need to understand. How does this affect family formation and how does it affect marriage? In a paper written, and this was the US, I understand, but these trends are actually showing themselves a little bit here in Zambia. This is a paper called The Mismatch of the Marriage Market. And single men are falling short of women's economic expectations. This is a paper that was published in the US in the United States Council of Family Relations and Journals of Marriage and Money, called The Mismatches in the Marriage Market by Daniel T. Litcher and Joseph P. Prince and Jeffrey Swigert. And using what they call the synthetic spouse test, where they asked women who are unmarried to start describing the ideal man that they would marry, it was discovered that single men were falling short of single women's economic expectations as followed. Single men were falling short of education. Now, what they also did, just to make sure this was correct, they actually went and took that woman's demographics and found a woman who had exact same demographics, where they were raised, what education they got up to, what industry they work in. They found that woman who was married. They found the married version of her. Then they assessed the man she married and said that given the same kind of variables, that woman would marry the same man. Here's what they found: that single men were falling short of women's educational expectations by 17%. They were 17% less educated than the ideal man they would marry. The single men were 20% less employed than the ideal man, and they were earning 37% less. Are women's demands excessive, or are men underperforming? There are two factors here. As women are becoming wealthier, as women are earning more, their expectations of men are rising, and therefore the marriage demands of a man are also rising. This is the reality of life, and people can debate this point, but the reality is that men are still expected of. We still live in a very traditional society where man is the provider. So as the woman goes into work, women labor force participation has moved from 59% to 71%, only 1% below men. They're earning the same as men. So they're expecting men, if they're going to be employed, they're expecting men to be employed. If they're educated, they're expecting men to be as educated, if not more. The expectations of the man is the baseline is the woman, and more is expected of the man. And this is the reality of what's happening. And therefore, the rise of women is kind of giving men no room to rise. So what is happening in society is that we should actually watch out for the destruction of family formation. Now, family formation is important for wealth building. It's important for entrepreneurship. It's important for legacy finance. If you want to pass on wealth, it's done through families. If you want to build entrepreneurs, entrepreneurs are done through families. If you want to build wealth, millionaires are mostly family people. So if you start destroying families, you're not going to get much wealth being built. Some people are going to have money, but not enough money to build legacy. The reason why families build million-dollar wealth or millionaire wealth is simply because families think about the next generation. That's the biggest thing that we always have to think about. Families think about the next generation. They really go into intergenerational wealth conversations. So that's a big thing to look out for in society, and a big change to see in terms of how that'll actually wreck things. Now, part of what I also wanted to maybe address is not just women's expectation, but also male performance. Men generally get much more economically active men generally get much more economically active when they have a family to take care of. So once family is disconnected from them, either they're not participating in it or nobody's marrying them anymore, and you just see the rise of the single childless man. That's actually rising, by the way. The number of single and childless men is actually picking up quite drastically as well. That also picking up in society is leading to a lot of economically underperforming men. Therefore, and remember that 3/4 of your entrepreneurs are males. So therefore, you have this less than expected entrepreneurship that needs to actually pick up more. And you need to actually juice them. They're the ones who take the risk. They're the ones who go into society and start their business. And you need them to start doing that. So other things that we have to look at in order to improve society is to look at what the next era, this decentralized, digitized, democratized system, what's it going to do to families and how do we navigate? So I would make this final plea to guys. This is time to find purpose in your life. I know that sounds like a fluffy conversation, but it's actually time to start looking for purpose in your life, because a woman and children may not provide the meaning to your life like they used to. It used to be that you had this woman who depended on you, these kids who depended on you, and you had to step up to the plate because you were the man and you were the provider, and this was your legacy on the line. But now you've got this woman who is economically independent. She even out-earns you. She's more educated than you, if not as educated as you, and you're kind of slacking now. You need to find meaning, because what's happening to guys is also quite destructive. They're taking drugs. They're going all over the place. Men starting to lose themselves. And maybe it's because the lack of family structure is leading to a society where they don't feel like they have a place. Find your place, find your purpose in life. That is the way the future is going to have to look. That's my future thought on how technology might be changing society. And men may need to take a bit more of a proactive approach in finding themselves. I know that this has been a long conversation, but I'd like to wish you all a wonderful weekend. Thank you for sticking out through with me. Watch out for the future trend. I've shared that information. Watch out for my future thought. It is a tough thing to look at, a tough thing to think about. But as society changes, let's try and get better. Have a wonderful week. See you next week.